Another type of costs that we talk about are opportunity costs. So opportunity costs are that benefit that we get if we choose an alternative course of action. So if you remember what our college student went back to, if he decided to drive, he picks up $200 versus the cost of a plane ticket. However, he loses the opportunity of 2 extra days on the beach. So in this example here, we pass up a summer job that pays $4,000 and instead attend summer school. The $4,000 payment or salary is an opportunity cost of attending summer school. Not necessarily that we made a bad decision, but we did make a choice to give up something in order to do that. Even though opportunity costs don't get recorded in accounting records, it's still important to think about when we look at different business decisions that companies have to make. Then we also talk about sunk costs versus out-of-pocket costs. So sunk costs have already happened and cannot be changed by future actions. They're therefore not relevant in decision making. Out-of-pocket costs are costs that are going to happen if we make a particular decision. So the only costs that are relevant to this decision are the ones that will happen if we make the decision. Sunk costs cannot be changed and we cannot get them back, so we never consider them when we're making business decisions. The next type of business decision we're going to look at is a special order decision. So special orders happen when our regular customers or even sometimes new customers come to us and have a particular order for something extra, something that we don't usually do. They might need a particular extra output. And we have to decide if we have the capacity to actually create that, if there's a benefit to taking the special order. So we have a company that manufactures golf balls. We currently have the capacity to manufacture 2 million golf balls a month, but our current sales volume only requires that 800,000 units be produced. At our current level of output, 800,000 golf balls, we have fixed cost of $320,000, variable cost of 20 cents per ball, or total manufacturing costs of $480,000 a month. So a company has come to us and they've requested a special one-time order for 500,000 golf balls or special label golf balls per month. The balls are imprinted with their name and logo. They're not identified by our company. The company has agreed to not try to sell them as competition with our regular customers. However, they're only willing to pay us for $250,000 per month for this order, which amounts to 50 cents per ball. We saw from the previous slide that our costs are currently 60 cents per ball. Is it profitable for us to accept this special order or not? So this would be regular extra income, but is it worth it? Because we're not covering that 60 cents cost per ball. So we need to look at what is the difference. So it appears to be unprofitable at first glance. So this offer of 50 cents per ball is less than our regular sales price, and it's less than our per unit manufacturing cost. But we have to look at this incremental analysis and which costs are relevant to this decision. For example, fixed costs are exactly the same whether we take the order or not. Those do not change. The variable costs are 20 cents per ball. So we have our regular sales without the special order, and then our new revenues with the special order. Our fixed costs are not going to change because we're currently within the capacity to create the extra number of balls. we have capacity to make 2 million balls. We're currently making 800,000 balls. This special order brings us up to 1.3 million golf balls. So all told, we will make an extra $150,000 a month by taking on this extra sale. When we're looking at special order decisions, generally, as a rule, as long as we have capacity and the cost of the special order, what revenue we get on the special order, covers our variable manufacturing costs, we're going to make money on the order because our fixed costs are not going to change within that level of capacity. So when we look at the relevant costs are only the variable cost of the 20 cents per unit because the variable costs are the ones that increase with production. Fixed costs remain exactly the same. Therefore, if we take this special order, we're going to increase our operating income by $150,000 per month. However, if we look at this example where we have production constraints, so a lot of the time when we're thinking about trying to decide what to do, we have to think about what our constraints are. We only have so many hours available in a day. We only have so much labor and manufacturing space, production space. So we have a studio that creates 3 products. We have watercolor paintings, oil paintings, and custom frames. We only have 6,000 hours of direct labor available to us. So we look at the contribution margin per direct labor hour required to complete each of the studio's products. So we have that watercolor paintings can have the highest contribution margin per hour versus oil paintings and custom frames. So we're trying to decide which one should we spend more time and energy on trying to sell that would make us the most money. So oil paintings generate the highest contribution margin on a per unit basis. However, they take the longest amount of time of any of our products. So watercolors are the studio's most profitable product per that direct labor hour. So when we're constrained by the availability of a particular input, in this case, direct labor hours, we should work to maximize our contribution margin per unit of that output to the level that the market will bear. Now, if Fran spent all 6,000 of her hours of direct labor on watercolor paintings, she would have to be able to be sure that she could sell that many watercolor paintings. So when we look at the different options, if we spend every available hour on watercolor paintings, we make $180,000 for a contribution margin. So remember, contribution margin is sales revenues minus our variable costs. A company usually can't just focus on the single product that's most profitable. As I said before, we couldn't just make watercolor paintings if all of those water paintings would not sell. Then we want to look at what is our sales mix. So that's what we talked about last week in chapter 20 when we talked about if we have 20% in sales of one product, 70% of one product, and 10% of another product, how do we market those products differently to increase our contribution margin per hour so that we create the most income with our limited resources? So in this case, our limited resource is the number of direct labor hours we have for making custom paintings.